Good morning, everyone. Today, I'm very happy to have Rob Oellermann join me. He is the CIO of Tantalum Capital and also one of our founding members. He manages all of our multi-strategy portfolios and is also our CIO. Rob, thank you for joining me today.
Thanks, Oellermann.
Rob, you've been managing money since 1994. So you've had 25 years of experience of managing money through various different crises. How is this crisis that we find ourselves in today different to other crises that you've managed money through?
As you say, there have been a number of crises that I have experienced, these sort of double-digit moves. They all linger in the memory. Started off with me, it was the Asian crisis in '97. Then there was the tech bust in early 2000. Those were all in response to kind of elevated prices. The GFC was also 2008, was also elevated prices. And then, of course, 9/11, which lingers, perhaps really firmly in the memory. COVID crisis is feels quite different from the other crises that I've experienced. Importantly, it was not directed or did not really start in financial markets themselves. And I guess in that way, the feeling that I had was a little bit more like the feeling after 9/11, where it was a little bit more of human behavior or activity change. COVID is all about human behavior. It's about consumer behavior, corporate actions, the usual predictable economic reflexes that one normally sees in these times, from asset and commodity price declines is just not present under lockdown conditions. And so that reflex that we would normally look for isn't there. Well, certainly not there at the moment. So at this point, we really have not strong conviction in forecasting how consumer activity and even corporate activity will recover post-lockdown. There's all the different scenarios that have been sketched by various pundits, V-shape, U-shape, L-shape, swoosh-shaped recoveries. In our view, we're going to see much more differentiated recoveries across the globe, from region to region, even state to state or city to city. That's based on governance differences, medical resources, and indeed economic resources. So, it's fair to say we expect a fairly wide range of market recovery outcomes from this point.
Rob, are there any specific areas of the market that have surprised you in terms of how they have reacted over the last 6 months?
There were a number of surprises. We weren't surprised by the speed of the sell down in general. I think some people have been surprised by that. We turned quite bearish on the global developed market indices, and we actively hedged a substantial proportion of our offshore equity, actually in early February this year, in those funds that had global mandates. So we were reasonably bearishly positioned and concerned about the effect of a potential shock on the market. I guess the lockdown measures were fairly closely correlated across the globe. And hence capital markets really moved in sync, and you get this very short, sharp correlated move, where for sure there were some opportunities that arose out of that kind of synchronous move and that close correlation. In some cases, there were idiosyncratic opportunities. So shares like some of the mining shares, Amplats as an example, had company-specific operational breakdown, and it got hammered even more so than many of the other mining shares. We felt disproportionately so. But there were also shares in the food and beverage segments, the tobacco shares, somewhat surprisingly, given their defensive character, and even the tech names, which in many cases actually stood to benefit from lockdown. They were all kind of universally hit in the initial stages of the crisis. Those are the main sectors where we then concentrated our attention and our buying activity. We always try to get the kind of strongest balance sheets, and we focused on the strongest balance sheet we could find. And that's the area I think where we've seen really good rally and a strong recovery. It's pleasing for me to see how much of the market upside we've been able to capture on the recovery leg, despite being fairly bearishly positioned on the way into the crisis. And look, I would hasten to say we're not all in equity, that's for sure. We still have a lot of cash on the sidelines, even now, ready to be deployed into further bouts of kind of choppiness and weakness. We expect the recovery to be fairly long and drawn out. And I think country to country and even sector to sector is still a long, hard road ahead of us. So more opportunities still lie ahead of us.
Rob, generally we manage our portfolios within Reg 28 constraints. If you were managing a portfolio that didn't have these sorts of constraints, how much would you have invested offshore right now?
I hear lots of topics on the ideal portfolio being more aligned to kind of a spread of global GDP. There's voices on this topic, and South Africa, obviously, we're a tiny part of global GDP. My view is perhaps a bit more pragmatic than some. Firstly, I feel that the JSE itself, the exposure, contains a lot of companies and equities which just happen to be listed in SA, but are actually global companies and global businesses. We know them well, and we understand them well as South African custodians of capital. So that's the first level of diversification. Obviously, there's the 30% offshore component, which is, I think, fully utilized by almost every Reg 28 compliant fund. And then on the domestic side, SA bonds and cash offer a very healthy yield pickup over developed market bonds and cash. So an investor in South African yield instruments, if one understands local risks well, can pick up a decent starting carry against 0% in dollars or euros. And then finally, the component of residual South African equity that is now, I think it's really keenly priced. I think effectively priced for an L-shaped or no recovery in many cases. So even there, I think that there is opportunity for a fund manager and a South African investor. So to summarize, I think the average Reg 28 compliant SA pension fund has at least in excess of 50% in global assets, be they JSE dual listed businesses or the 30% offshore. And then on top of that, I think that there's really cheap assets around. So I think we're reasonably well served where we are under current regulations.
Rob, with managing multi-strategy portfolios, you have both the levers of stock picking as well as asset allocating at your disposal. At the moment, what do you think has been more important, getting the asset allocation call right or getting the stock picking call right?
Look, in times of crisis, and this recent one particularly, asset allocation was the key over the time of the crisis. If you had a portfolio invested only in US dollar cash or in maybe US dollar bonds, that would have been nice. But the amount of, and that was for a very short period of time, the amount of liquidity that was flushed into global markets from all quarters really meant that you had to be very alert and take on more risk exposure quite quickly without much visibility at that point in time. This kind of tactical asset allocation, I guess, was quite hard to do top down with real conviction. We did quite nicely out of our asset allocation, as I said earlier on, being reasonably conservatively positioned into the crisis. To really gain conviction coming out of it, we focused on areas of the market that seemed disproportionately hit. And we were quite selective in buying assets in that time period, given that wide range of outcomes, really trying to focus on safe businesses, well-capitalized businesses with strong franchises. Net, we managed to add some really, solid exposure at good levels. I think from this point, markets have bounced quite hard. It still feels like asset allocation will define a significant proportion of fund returns and fund outcome from this point, certainly in the shorter term, and I'm saying of the next kind of 6-12 months. But interestingly, the very wide divergence that we've seen at the stock level and the sectoral level is becoming really significant. And I expect that stock selection and sector selection going forward now will become just as important as asset allocation. I mean, just the simplistic example really is on the tech side. Do you hold your tech winners regardless of price? Or can the consumer and industrial shares that have been so hammered really get some, if they get a little bit of top line growth, I think they are way too cheap, and I think that you will get outsized returns from those sectors of the market. So I think it's shifting from asset allocation only to a stock selection period ahead.
Rob, you've often mentioned to me that you continue to learn every day in this game, and that it often humbles you. Over the last 6 months, what is one lesson or a couple of lessons that you have learned, or at least have been reminded of?
I think the number one lesson for me, if I needed reminding, is that diversification is still really key to successful long-term fund management. It's human nature to get suckered into admiring and then following narrow winning streaks, be they corporate success or winning shares or portfolio flows. It's very tempting, but COVID, it's another reminder that forecasting is perilous, and the past doesn't represent a picture of the future. We cannot predict what lies ahead. So in an environment like that, if you panic as a fund manager, it's the worst possible thing that you can do. I think having an experienced kind of cool hand at the tiller is important. And then a portfolio which is reasonably well balanced, smartly balanced and diversified, not just having something everywhere, but knowing which risks you are balancing and understanding the risks in your portfolio. If you manage that well, I think it's essential to the fund management process. So it's a reminder for me of how important that balance is and diversification.
Rob, thanks so much for your time this morning. It's always very insightful to sit and chat to you. Good luck for the coming months, and we look forward to having a session like this again soon.